Good morning, everybody, and welcome. My name is Anthony Kazazis, and I am the director of the NYC Network Group, as well as the NYC Real Estate Expo. And I want to thank you all for registering today. The webinar is sponsored by Emigrant Funding, Dynamic Commercial Lenders Panel. Learn about the wide range of commercial mortgage products out in the market. Today, you'll hear from the panel of commercial lenders, each offering a variety of products and programs. You'll gain from this webinar knowledge of various commercial financing avenues to better serve your clients. Our sponsor today is Emigrant Funding Corporation. Emigrant Funding Corporation, EFC, is a direct portfolio lender specializing in first mortgage financing for most types of owner-occupied and investor-owned commercial real estate. And additionally, EFC, through Emigrant Bank, is a participating small business administration, SBA lender. EFC offers SBA 7 Type A loans and a 504 program. As a subsidiary of Emigrant Bank, a 167-year-old savings institute, EFC is able to draw upon the vast resources of its parent to make sure borrowers get the funds they need in a timely manner. Emigrant Funding Corporation as well is a portfolio lender that can offer you out-of-the-box niche transaction lending. Our speakers today are Charles Ruffin, AVP, Sales Emigrant Funding Corporation. Charles will also be our moderator for today. Welcome, Charles. Emigrant Funding guest panelists are LaShawn E. Talley, Vice President, Senior Business Banker, Tri-State Area, Citibank Retail Bank. Igor Vesberg, Managing Director of Hirschmark Capital, LLC. Toby Abraraji, I'm sorry, Toby, if I pronounced that wrong, Vice President of Basis Investment Group, LLC. Wendy Scarlett, Vice President of Commercial Real Estate Lender, Poplar Bank. And Elliot Aguilar, Regional Manager of Ponce Mortgage. Without further ado, ladies and gentlemen, Charles Ruffin from Emigrant Funding. Welcome, Charles.
Yeah, thanks a lot, Anthony. And thanks a lot for those who are attending. We have a dynamic panel here, so we're ready to get started. So Anthony pretty much gave a good introduction as far as the individual panelists. So I'll just start off with the questions. So we'll start off with Igor, from Hirschmark. Igor, dealing with bridge loan financing, mortgage brokers typically know what it is and the benefits of it. But can you kind of define exactly, because we have a lot of individuals who are here probably listening that might not be familiar with private lending, bridge loan lending, and pretty much just familiar with regular bank financing. So can you give the benefits of going to a private lender?
Sure, and good morning, everyone. Thank you for having me. Well, first of all, I'm not really the lender you want to see first. It's usually some of my panelists here is usually the first choice. But the benefit of going bridge is that we're very flexible, and I think that really we have 3 categories of situations where we can be helpful to borrowers and also helpful to other bankers actually. For example, speed. If something needs to close very quickly, if there's a TOE transaction, if another bank drops out, for example, or look, if you need to close quickly, period. We can close within 2 weeks. There's no investment committee. It's just really us. We can make the decision on the spot usually. The second, well, like I said, first is speed. The second scenario is usually the individual sponsor has some issues. So it could be some credit issues from the past. It could be maybe like a bankruptcy from the past. It could be a foreclosure. So, we're looking at the asset. We're also looking at the individual, but we know who we are. We're not a regular bank, so we're more focused on the asset. So once the borrower shows us, or rather shows another lender good payments with someone like me, they can usually refinance with some of my colleagues here on the panel. And the third reason is like a specific collateral. So let's say if it's vacant, or let's say if there's no debt service coverage or insufficient debt service coverage, we can come in, give a bridge, and then after maybe 6 to 9 months of good payments, and also the property's leased up at that point, he or she can refinance with another more conventional type lender. So it's really kind of those 3 scenarios where we can be very helpful to a borrower and a bank as well.
Excellent answer, Igor. So Toby, with your institution basis, a wide variety of platform of different types of lending that you provide, and you specifically focus on Freddie Mac. But just give the audience again, because a lot of maybe, or at least some of the individuals viewing, they might not be as familiar with agency financing versus local bank financing. So give a little bit of highlights of why somebody might choose your platform, which you specialize in, over other platforms.
Yes, thanks, Charles. As Igor suggested, we do offer permanent debt. So with permanent financing, these are longer term loans, typically 5, 7, and 10-year terms. And interest rates are also, more at par with what you'll see in the market. For example, right now, we're about 3.5% on most products within the agency world. Also, we are able to go anywhere in the country. We're nationwide lenders as well. Freddie Mac prides itself in providing financing and liquidity, especially in times such as these, where a lot of banks will cease to lend. So Freddie Mac has been lending since the start of the pandemic. The only thing that has changed really is maybe we're not able to do 80% financing like we used to do. Right now, we're about maybe 75 and maybe 65 in some cases. But we have all the bells and whistles of interest only. We have flexible prepayment penalty features with the loans. And so most folks will come to us first, or a traditional lender. But for any one number of reasons, if the deal doesn't actually end up to materialize, then it might go to a bridge lender or a non-traditional lender, if you will, to fix whatever the issue is, and then come back to us to get that permanent financing.
Gotcha. That sounds great, Toby. So Elia, with your institution, publicly traded, a couple questions for you. Why are you different from other lenders / banks? And what is the greatest benefit of doing business with you versus, say, other lenders just in general, like with your institution?
Oh, sure. Because we are a portfolio lender and give us the flexibility of being creative, use common sense underwriting, and tailor your loans for your needs. For example, I did a loan where it was for a congregation and they was purchasing a building. They didn't have enough cash on hand. However, we knew the cash flow was there to support the loan. Ponce was able to take out additional collateral and make the loan work. Also, I know that the lender, I know they will benefit a lot from our product because we do due diligence at first, and we do pre-screening with upper management, and our closing rate is over 90%. When we give out commitments, it's clean commitment and no conditions. So it will be a lot of benefit to do the loan with us.
Excellent. Thank you, Elia. Wendy. Hey,
Hi.
Wendy. Hi.
Hi, Charles.
So quick question. So dealing with your institution, what are your bank's current lending parameters for construction and perm financing during COVID? Because right now, and I do get the request at times dealing with construction financing, and it's a rarity when you look at banks that are doing it. So what would you say, just a general outline of, your bank's position and what makes you feel comfortable regarding construction projects currently?
Well, thank you for having me, and thank you for the opportunity to share. Now, Popular Bank has been lending in the New York City area for over 52 years. So there's a commitment there and a belief in New York City and its resilience. So when it comes to construction lending, we're really looking long-term. Any project, my typical projects are 18 months minimum, mostly 24 to 30 months. So we are projecting well beyond the pandemic. Our construction lending is, usually runs around 5% as far as the interest rate. We look at the debt service. So even if it's a condo project, we will look at the loan from a rental fallback perspective. And if a debt service is there, then, we feel confident in moving forward. We also, something Elia mentioned about the term sheet. Our term sheets are well vetted. So they're well vetted with upper management, especially when it comes to construction lending, because of all the moving parts. I want to make sure when you have a term sheet, it's valuable, it's real. And that's what I can say. It takes us a week to issue a term sheet, but once it is issued, that we're standing behind that. Our construction loans range from $5 million to $35 million.
Okay.
And through COVID, I personally closed close to $40 million, mostly construction during COVID. So that just bears to the bank's commitment to, the right projects, of course, and the right developers and sponsors, but our commitment is there for construction lending.
Excellent. That's excellent. Well said. Well said. Igor, we're back to you. Now, as far as with the bridge loan criteria, individuals are interested in dealing with leverage, dealing with lending territory. Ballpark, can you give us a general idea of that, and property type? That's very, important as well, because not all lenders, lend on all property types. So what would you say you feel comfortable with your institution as far as, those, especially dealing with property types?
So that's, Charles, three things: geography, leverage, and property types.
Correct.
Okay. So when it comes to property types, we're pretty much agnostic. We'll do like an investment condo. We'll do from an investment condo to a piece of land and anything in between, multifamilies, industrial, really anything. We're not very aggressive in hospitality. We never were. In today's world, in the new normal, I think we're going to continue to stay away from hospitality. We don't really touch construction. Like ground up construction is not something we would ever do, just because it's not something we really understand. But when it comes to, like, let's say someone's acquiring a piece of land, we'll give him, him or her the acquisition financing. And then once the borrower, does some kind of work, then they'll usually go to like someone like Wendy for the financing. When it comes to leverage, leverage is across the board. I mean, really depends on the project, but we'll never go above 65%. That's kind of where we max out. And the third question, I'm sorry, was geography. So geography, historically, we're a New York City lender. I would say one of the most active bridge lenders in New York City. We can usually size up a deal within an hour or two and usually issue a term sheet the same day. And that was the benefit. Through the pandemic, we started kind of expanding to the tri-state area, like New Jersey, Connecticut, Pennsylvania. We'll look at deals there as well. Florida is someplace I really want to start lending a lot more. So if there's any deals in Florida, please send them my way. I would love to do the site inspections in those deals. Yeah, so
I bet. Wouldn't we all, especially the weather today. Okay, Toby. So Toby, as far as like dealing with the typical underwriting and things of that nature, and as far as like the process, and what's something you would advise a broker or necessarily a borrower, something you would like keep in mind in the beginning to make sure you don't have any hiccups later on. So just give me a general idea of the process as far as with, a Freddie, that type of loan in general.
Yeah, so when we size up the deals, we have a team of analysts. They're sizing deals all day long. So we really dig in. We're looking at what the property taxes are, whether or not the property will be reassessed if it's in the case of a purchase kind of transaction. And also, I always encourage folks to tell us everything. A lot of times you get borrowers that get a little bit cagey about telling us if they had a past bankruptcy, any ongoing litigation, judgments, things like of that nature. But I always tell folks, we're going to find all this stuff out once we run the background. So it's always better for us to, go to Freddie Mac to do a pre-screen so that we can really firm up our quote. Because, end of the day, nobody really wants to, get retraded on any of these deals. So it's always better for us to, find out as much as possible about the borrower and the asset. And then at that point, let's get the cash flow, other collections, what you say they are, because especially right now in the pandemic, collections have been a bit anemic since the start last year. So, that's something right now that Freddie Mac, as well as the other agency lenders and Fannie have really been honing in on to make sure that, yeah, you can have 100% occupied property, but your economic occupancy could be, like I said, 75%, especially here in the boroughs. We've seen a lot of that. So we try to dig in and get as much information as we can just to make sure our quote stays firm, but things always happen.
Yeah, tell me about it. In general, just say if you had everything going as planned, if that can ever be possible in a commercial deal, what's like a typical time period? It's during COVID right now. How long is it taking currently to get that deal processed?
Well, quite frankly, 60 days is the max, but we've closed as little as 45 days before. I think the biggest challenge right now has been scheduling site inspections, because a lot of tenants, they don't want anyone coming into their unit, and then trying to deploy a third-party appraiser, the engineer, coordinate with Freddie Mac, and then somebody from my office also has to, the inspection. It's been challenging. So we've started using Zoom and Microsoft Teams to actually cut down on some of the lag time and get info. So if we just get one or two people go out there, they just carry their cell phone around the unit and the property, and we can wrap it up. So I think that's probably going to be a best practice from all of this after COVID is over and done with. I think, maybe we'll save some money on travel costs, and that would be the new normal.
Oh, very unique. I'm glad you mentioned that. Very unique. Okay,
Yeah.
That's great, Toby. So next, we're gonna go back to Elia. So Elia, with your bank, what property types do you feel comfortable lending on these days, and what are your typical terms, loan size, as far as dealing with interest rates as well associated with those terms?
Well, we do multifamily, mixed use, two to four family investment, retail, office, commercial condo, underlying co-op, and warehouses. Typically, our loan size range from 1 and 5 million. However, we could go up to 30 millions. Our amortization is based on 30 years and 25 years for mixed-use property and commercial properties.
Gotcha. Excellent. Okay, thank you. So Wendy, regarding your bank, what type of construction projects and what type of stabilized properties is your bank currently financing? And what would you say is your ideal client for a Popular Bank, experience level and liquidity wise?
Okay, great question. We focus on multifamily. Even pre-COVID, the bank always had an aversion to retail. So heavy retail, those tend to be a huge challenge for us. As far as construction lending, it's multifamily. We will do some commercial construction in mixed use. But again, if you're talking about a large portion of the cash flow coming from commercial, community, or anything non-residential, it's going to have to be pre-leased, which is not realistic. So what I like to focus on is multifamily construction with very limited mixed use, maybe a community space or two, some limited retail. That's typically it.
Gotcha.
And we do perm, but in this environment, most of my successes have been in ground up construction, honestly, because there are a lot of caveats, higher debt service, higher vacancy rate, a PG on multis. It's a burn off, but still it makes it difficult to fit clients into that box when it comes to where we are now with our perm lending.
Gotcha. And so dealing with like certain banks are what we call relationship lenders, others aren't. Would you say with your bank, you guys would fall into the relationship lender, say if that particular client borrower moves accounts over, stocks, bonds, or whatever liquidity, maybe a preferential rate, or some banks will say, this is what you need to do in order to get the loan, period?
Okay, that's another good question. Now, we are a relationship lender, meaning we're not looking for a one-off transaction and then that's it. We're looking to build a relationship because it helps. Construction lending is the riskiest lending there is out there, say. So, of course, banks and credit feels more comfortable if we're doing, we're working with the same developer. Now, that's not to say we do, we don't welcome new blood into the stream, but And a lot of my, again, last year was when COVID hit, 90% of the loans that I closed were for new borrowers,
Okay.
construction loans. So liquidity is top. So we're looking for minimum, any equity due liquid plus 10% of the loan amount liquid outside the project. In case of those inevitable DOB delays, we want to make sure the borrower has the wherewithal, and experience is also very, very key with us with Popular, because we want market experience built before in New York City, Brooklyn, Queens, the Bronx, Manhattan. So very well vetted, experienced sponsors. And the mix of the deal still has to make sense. So it's hard to segment one specific thing that is more important. It's a composite, really, when we look at the deal, the experience, liquidity, and then the matrix of the deal. Does it cash flow? Does it make sense?
Excellent,
That's-
excellent.
yeah.
Makes sense. So LaShawn, let's go back to you. Let's see if we have your audio on.
Do you have me?
Yes, yes.
Okay, technical.
Good.
Okay. So, LaShawn, like I mentioned, I go back to that initial question for you. So what we see, especially like in Manhattan, New York City, a lot of distress just dealing with, I guess, entrepreneurs, property, not necessarily what is a portion of the property owners, but business owners. That's what I wanted to concentrate as far as your question, because, you see different retail type of units, basically empty in certain areas in Manhattan. So in order for us to make that turn back to, New York City, coming back to where it should be, capital is very important. So how do you look at, as far as owner occupied request, as far as portfolio? And I know you have the SBA program, so certain individuals might not know the advantages of just SBA as well. So can you give us just an overview, a highlight of how it is working with Citi regarding those points?
So at Citibank, we look at several things here. And as the third largest bank, you will find that we specialize in owner occupied properties for our clients. We look at cash flow, which is primary, also collateral, and third way outs, which is the personal debt. We look at commercial office space. We look at condominiums. We look at co-ops, manufacturers, and what's booming now is IT solutions. We do have a specialty niche for our healthcare industries, and that's your medical, your dental, and veterinarians, where veterinarians and those particular specialties, we can actually lend to them if they occupy 25% of the space versus 50% of the space for our general owner occupied. With SBA that comes in, Citibank is a preferred SBA lender. And so the client can actually put down 10% versus 20% of the property. The nice thing about my position here at Citibank, I'm actually the quarterback for the entire deal, where I work with the client from beginning to end. And so with SBA, I'll work with the CDC lender directly, hand in hand, to get the client to the finish line. Depending on what type of program that the client chooses, whether it's 7A or 504, is going to depend on the requirements and what they made. 7A, they do require life insurance, whereas the 504 does not require life insurance, but we take a full lien on the residential homes as well. So there are different things that we can do here at Citibank, but the goal is to do what's best for the client.
Yes, great answer. And I'm going to ask you another question because of the issues we had earlier. So we talked about, just dealing with the business owner that owns the real estate, but a lot of these individuals, they lease. So what type of programs do you have, more or less, maybe for term loans, or like a line of credit, or, for those business owners who might not own the real estate itself? What type of credit facilities or programs you might have for those individuals?
So that's a really great question, because a lot of businesses, given COVID, have really need these facilities to get through, besides the SBA programs that are being offered. So at Citibank, we do offer term loans. The terms for term loans can range anywhere between a year to 5 years. This may be a great time to purchase equipment. If you're looking to expand the space, you may need some, I would like to say, cosmetic build out. It's a great opportunity for term loans. You can also use it as working capital. You want to make sure that you're using term loans for a long-term plan as far as lending. When it comes to lines of credit, as we know, some people are, their receivables are building up, and some businesses are not being able to pay their receivables in that 30-day time frame. And so a line of credit is going to come in handy for that purpose. We will finance ARs up to 85%. We do look at ARs that are not concentrated as well. So that's something that we can do too. A lot of clients also who also take commercial mortgages with us will actually add on a line of credit or a term loan to help with their move or to help with some cash flow too as well.
Excellent, excellent, excellent. Thank you, LaShawn. I'm glad we got that audio fixed.
Yes, yes.
Excellent answers. So we're going to go back to Igor. So Igor, dealing with Hirschmark and, just dealing with the environment, the COVID environment, there's certain entities out there that's like not lending, certain individual institutions, they're lending to their primary client base. But how is Hirschmark dealing with the environment now as far as lending in a time period of COVID?
It's a good question. I mean, I guess when the pandemic hit, I think everyone kind of like, just got frozen for, I think, maybe a few weeks. It was definitely a scary time. And I think for about 3 weeks, we kind of, well, it's actually interesting. We did close one deal that I guess like right in the beginning of everything. But after that, it was just like a total timeout. But I think 3 weeks later, we started lending. We had a fairly busy 2020, I think around April, May, we really kind of started seeing deals again. And look, it wasn't the best year in history, but it definitely kind of, in light of everything, I think it turned out pretty well. So, I mean, I could say that we're still, active. I mean, the 2021 started off with a bang. I mean, we're definitely, doing a lot. And I think, towards, hopefully we'll get through this pandemic this year or maybe early next year, dare I say. And I think things will somehow get back to normal. As far as kind of some of my kind of friendly competitors, a lot of people are just kind of like not lending in my space. Kind of like, so for us, what we try to do is we try to just be careful, kind of stick to what we know, stay conservative, but at the same time, stay very flexible.
Excellent, excellent, excellent. Thank you, Igor. A quick question too, just dealing with the issue of PG versus no PG. As far as on the private lender side, I mean, do you guys typically require someone to give a personal guarantee, or is there any time period that the loan could be more or less non-PG, no PG, non-recourse?
Yeah, so I mean, historically, most of our loans do have a PG, and our borrowers are sort of okay with it. If someone is very uncomfortable with a PG, I want to understand why, first of all, and we can sort of dispense with that requirement if there's a good loan to value and there's some kind of good story why they don't feel comfortable. So I guess it's very case specific. So, but to answer your question, I'm comfortable just having like a springing PG.
Gotcha.
Yeah.
Okay, and say for example, someone, you provide a loan for them, but 6 months later, for whatever reason, they have to come back, they want more proceeds. Do you guys have the ability to give like a second mortgage, assuming you guys feel comfortable with the leverage?
Yeah, so it's funny. It's actually, it doesn't happen too often, but it's happened last year, like probably the most it's ever happened since 2008 when we started. So yeah, so right now we're actually closing on Friday on a second position loan to the same borrower. She needed more money, and it wasn't a huge loan. It's just she's in the process of selling the property, and she's like, look, she goes, I can sort of carry the loan. I'll take a little bit more money. I'll pay for the capital, but then if I hold off, I think, kind of when the pandemic is hopefully in the rearview mirror, she can get more money for her property. So we were happy to basically just give her a second. For us, it's, I think like Toby mentioned, we like to know who we're dealing with. So if the borrower is sort of good to us, and we'll bend over backwards to sort of accommodate.
Gotcha. Great answers. Great answer. Thank you, Igor. So now we're going to go to Toby. So Toby, with your particular platform, Small Balance, what happens when you get that, $10, $15, $20 million deal? I mean, do you got to say, sorry, I can't do it? Or do you guys have the capability to come in and say, yeah, hold on. I got a program for you. It's just another bucket of financing.
Well, Charles, that's a great problem to have, right?
I tell you about it.
So what we, Basis is actually, it's a minority women-owned company. So with that designation, Freddie Mac has actually given us the ability to, finance deals, for the conventional program with minority and women borrowers. So any deals from $5 million to $90 million, we actually can actually go after those deals ourselves. But on the flip side of that, we also have a correspondence with M&T Bank, which allows us, to do some Freddie Mac and Fannie and Life Code deals with them as well. We don't charge any more for those deals. They're priced accordingly, depending on what market is and the transaction quality, all that. But it's just a way for us to kind of get the word out and just have more volume. It's a volume-based business overall when you do agency lending. So we don't throw them away. We just find another way to do them.
Well, that's a great, I'm glad about that, Toby.
Yeah.
So just dealing with, as far as like debt service coverage and things of that nature, what's like the minimum you guys might have for a deal dealing with debt service coverage and dealing with occupancy requirements? What would you say would be like the minimum for that?
Okay, well, let's start with occupancy. So with occupancy, any building that's, less than 30 units, we can do 85% occupancy for 90 days. Any property that's over 30 units, we need the 90 for 90 rule. So 90% occupancy for the past 90 days is what we consider to be stabilized. Mm-hmm. And in terms of debt service, pre-COVID, we were doing 80% loan to value, 120 times coverage in top markets like New York, Los Angeles, and places like that. But since COVID, if you're doing a cash out refinance, we've now since been at 75%. 130 times coverage. And then it gets a little bit, interesting once you talk about, we have a COVID reserve that we have been taking since last March. So the COVID reserve is really 12 months of principal and interest that we collect on these deals, and then we release that after 12 months. If everything's going well with the property, Freddie Mac will release that. So if you have a deal that has strong cash flow, we're at 65% leverage, let's say 150 times coverage, then instead of 12 months, we'll collect 6 months. And then if you have an even stronger deal, that's 60% leverage at a 160 times coverage, then we can waive that escrow altogether. So 130 is our marker for now.
Gotcha. Excellent. Thanks, Toby. So next we're going to go to Elia. So Elia, just like what Toby was mentioned, a time period of COVID, banks are having different requirements. Some have like a COVID holdback. So, dealing with your bank, how are you guys dealing with that? Is it like a holdback for a certain amount of months that's kept, on the side, and then the borrower makes their payments on time, then it's released? Or is the mortgage payment applied towards a COVID holdback? Or do you guys have like no COVID holdback at all and everything is great? How would you say your bank does that?
Well, Charles, that's a great question. But first of all, I want to let you know that during the COVID, we never stopped lending, okay? We are more conservative, but we never had stopped lending. And I was able to close $11 million construction loan during that time. However, unlike the agency, our holdback is only 6 months PD, which is released after 6 consecutive on-time payments.
Gotcha. Okay, that's not bad at all. Excellent. And, Elliot, since we have here, like dealing with rate structures and things of that nature with the term. So I know we mentioned briefly like terms, but what would you say, assuming it was like your standard, say, multifamily deal, as far as leverage and ballpark idea of interest rate?
Well, our interest rates, I would say low fours.
Okay.
But remember, we are like very creative and unique when it comes to do the loan. We really do a lot, and we really close your loan. If I say to you, I'm going to close your loan, it's because I'm going to close your loan. like I said at the beginning, I had 90% or more of closing ratio.
Gotcha. Okay, excellent. Thank you, Elia. So now we're going to go back to LaShawn. So LaShawn, dealing with the process overall, because you mentioned you're the quarterback in a sense with your particular team. So how would it work when someone's basically applying, and what, just like I mentioned to Toby as well too, what kind of things you would maybe ask that particular bar up front to make sure there isn't an issue later on down the line, in which, to make sure just didn't waste like a couple of months or so. But what's the overall process for new submission with Citi?
Sure. So any client that comes to us, we need to make sure that we find out what the exact need is. And when you're talking about commercial mortgages, we want to make sure that the client actually has that purchase agreement at hand to make sure that they are purchasing an actual property, because a site visit's also going to be required. But the beginning steps are the financials. So if you're looking to purchase property, try and have your recent financials up to date, meaning we look at 3 years of business tax returns, 3 years personal tax returns, and of course your interims, balance sheet, profit and loss, know your debt service too on your company. We will look at also what you're paying in rent, because remember, the rent's going to go away. You're going to have a mortgage to pay. So you want to make sure that you're keeping those records all clean. And then going forward, once we see that the deal does actually cash flow, because we want to be your partner, we don't want to own the property, we're able to move forward. And basically it will go through full underwriting. And then once it goes through full underwriting, at that point, and if it's found favorable, we will issue a commitment letter. At that time, you do have the opportunity, once the commitment letter is issued, you'll have 5 days if you choose to lock into the rate. And as you know, rates are extremely low right now. So we recommend our clients, and it is the client's choice if they want to lock in a rate. And at that point, you will hire the appraiser and the environmentalist, and we'll go through the process. I'll be working with the bank's attorney and the different departments to close the loan, and you'll be working with your attorney as well, the client. And I'll be checking in with the client from time to time to make sure that the paperwork is moving properly and that everyone is on board accordingly, so that we know that within, I would say, about 60 to 90 days, we're able to close on time and there's no surprises. Some of the surprises that we may have could possibly be the environmental, where phase 1 comes back and we might need to do a phase 2. But most of the time we work hand in hand. And if it goes SBA, SBA will be working together too as well to close.
Excellent. And quick question too, like we were talking about like COVID holdbacks and things of that nature. So for Citi, I mean, you have the portfolio, you have SBA. How is Citi handling that particular point, dealing with any type of holdbacks, dealing with new submissions?
So, and I appreciate that question, Charles. So Citi has been lending throughout the whole entire pandemic. They have not stopped. I would say with Citibank, we worked with our clients with existing mortgages that had a financial need to work with. And so those mortgage payments were deferred on a case by case, anywhere between 3 to 4 months in regards to that. With SBA being a preferred lender once again, under the CARES Act, SBA is making those payments on the commercial mortgages, the 7As, anywhere between 3 to 6 month payments.
Gotcha. Thank you, LaShawn. So now we're going to go to Wendy. Wendy, what do you believe Popular Bank's strengths pertaining to pre-financing? And also give me a good idea, we're talking about the COVID holdbacks, so anything more specifically about that, but what would you say, when individuals are talking about your particular bank and when you're talking about your bank, what is that, competitive advantage?
Yes, our competitive advantage starts with the turnaround time. And I'll talk from beginning to end because it is segmented. So when I deal with a lot of brokers and returning developers, a word of mouth, because of our reputation in the industry, we do a lot of lending throughout Brooklyn, Queens, and the boroughs, excluding Staten Island. So when I do get a deal or a request, my goal is to turn it around, yes or no, within 24 hours max. As a broker, the brokers appreciate that because everything is not a fit for this bank, quite honestly. that's good, but you need to be upfront and tell the broker or the borrower no, so they're not spinning wheels and frustrating the effort, right? Feeling frustrated in the effort. For those deals that do work, I can turn around a soft quote, rate, terms, general, bullet point, again, within 24 hours. Then the following week, we have a weekly pipeline meeting. Every single Tuesday it happens. And that's where the deal is screened. It's pre-underwritten. Cash flow, borrower experience. On the construction loans, it would be total project cost, the budget. And so we get buy-in within a week, not only from upper management or directors, et cetera, but also from our chief lending officer, the chief credit officer for the entire bank. Participates in a Wednesday meeting where the deal is screened. So by the time I get an okay to issue that term sheet, you know it's been well vetted. So that's a strength. Then the rest of the process, a lot of it is dependent on how quickly the borrower gets information back to us when we ask for it. Third parties, typically 3 weeks to 4 weeks, because I'll focus on construction. We'll look at, we need a plan and cost review to make sure that the cost to build make sense, that they're within line. We do an environmental report to make sure it's clean, and then the appraisal. And this is all projection, pro forma, to make sure it cash flows. And debt service right now, to give you some specifics, is 1.30. Pre-COVID, it was 1.20 on a multifamily. So yes, we've adjusted to the new environment, but we're still very much lending. And borrowers understand that. And brokers understand that. So it's 1.35. Pre-COVID, as soon as total loan to cost on construction, pre-COVID, it was 70%. Now it's 65%. And the LTV, which drives the rate, with a 65% loan to cost, 55 is probably the LTV for a project to really make sense, to have any profit in it. So that's not a small hurdle. That's not a high hurdle to hit. That's not difficult for a construction loan to be 55%, and that drives the rate. We use a program that takes into consideration how the loan will be funded. For instance, if you have no debt on the land, that's good, but we're not getting money out the door. If you do have debt and we have to pay it off, then that helps the rate because we're paying off that debt. We're a first position lender only. So there's no mezz or anything else. So we have to make sure any debt that you have on the land, for instance, if you went to Igor for your bridge loan, we'll be paying off that bridge loan with a construction loan. Then on the perm loans, well, it's 1.30 debt service. We have no IO period anymore. So pre-COVID, we did have maybe a 1-year IO, but now we no longer offer that. We do a 6-month holdback P&I, and after a year or so, it's released if payments are being made as expected. The LTV maximum 65% on the perm loans.
Gotcha.
Yeah.
Hey, that sounds great. All right, thank you, Wendy. So we're going to go to Igor. We're almost coming close to an end, but so we might have a couple of quick questions. Roughly have about 4 minutes, but these aren't really difficult, long answer type of questions. So in general, Igor, just dealing with out-of-pocket expense, because a lot of times, just depending on what private lender you're going to, it can vary. So what would you say as far as getting to the finish line, what upfront, it's deal by deal, of course, but in general, what typically would the borrower have to pay out of pocket, and then in order to go to closing, initial expense?
I think this is where we kind of really set ourselves apart. We take a small deposit upon term sheet, and that's not like a separate fee. That deposit, the borrower gets a credit dollar for dollar at closing. So it's not, at least it's not like a line item on the closing statement. And on many of our New York City deals, I would say the large majority of them, we do not do an appraisal environmental just because we know the real estate so well. If it's a piece of land, we will do an environmental, of course, but I would say 80% of our deals do not require one. It's just legal and background check. And background check is like a couple of $100. And legal really kind of depends on what our lawyers have to do. If the borrower's attorney is responsive, then it won't be a lot. So I think there is where we really could save the borrower a decent amount of money.
Gotcha, gotcha. Excellent, excellent. And Toby, quick question, just dealing with, property types and things of that nature. So we know multifamily, mixed use, but what percentage, as far as mixed use would that particular property, maybe either dealing with the rent coming from it or square footage would fit into your platform? And dealing with underlying co-op financing, is that a property type scenario you can look at as well?
So we don't look at any co-ops. Historically, Freddie was able to do that maybe like 5 years ago or so. But it's so many, there's so many lenders in that space that they don't really bother anymore. Um, as far as mixed use properties, we can look at them, we'll say 40% of the income, no more than 40% of the square footage can come from the commercial component. So anything that's above 40%, we have to get an exception from Freddie Mac to do those transactions. And if it's above 50%, then that's just a non-starter. So right now, because of the pandemic, we are not allowed to really, just quote really any mixed use deals out the gate. We have to pre-screen the commercial income with Freddie just to make sure it's still a cash flowing business. So if it's like a restaurant, that could be problematic right now versus if it's like a real estate office or something. So it depends what kind of business occupies the commercial space is really what's gonna allow us to move forward to include that income. But 40% is the threshold.
Okay, thanks a lot, Toby. And we'll wrap up with Elia. So Elia, just dealing with lines of credit, that's kind of unique dealing with commercial real estate financing. So usually, you hear that all day long on residential requests, but what about commercial real estate financing lines of credit? Can you give us a little bit of highlights on that? I think we have like a minute or two left.
Okay, that's a good question because it's a great product. Okay, we do line of credit as the first position, but also we allow first and second as long as with us. Like for example, I did a loan where it was like a $10 million. We give the first and they was able to withdraw the whole amount, let's say 4 millions. And then the rest of the 6 million, they use it as a line of credit. So basically we divide it into two.
Gotcha. And what are the typical terms of it? Like, what's the interest rate and how long is it, like for like 5 years or 3 years for the line of credit?
Well, it would be 5 years. A lot of time you had the option to extend it for extra 5 years. And in reference to the rate would be prime +2.
Oh, prime +2. Gotcha.
Mm-hmm.
Okay.
But we do it like for the commercial. We do it for basically all different type of properties.
Okay, excellent, excellent. So next we're going to just basically go to LaShawn. LaShawn, as far as, the general lending territory, comfort level and things of that nature, because when I think of like business bankers, usually I think of like specific lending territories. So how is that, with your particular institution? And just say if you had someone, Citibank is like nationwide pretty much. If you had someone in just say California, it's a client of the bank and things of that nature, might be based in New York, but maybe, a new location in another state. How does that work with your organization?
Sure. So I cover the New York territory, the tri-state area, but we've had deals where we've had clients in Florida doing lending deals or in California. And for example, we'll partner up with our partners in Florida to help with the deal. And basically, if the business owner is here in New York, we're pretty much doing the legwork, but the building may be in Florida or a second office may be in Florida. And so our partners in Florida will complete that site visit and work with us. The goal is, as long as the client is within 70 miles of the nearest Citibank, we are able to lend to them. They're considered to be in our footprint. And when it comes to actually healthcare, which is our specialty niche, there's a little bit more leeway in regards to the lending locations for lending to our clients. And that's whether it's a term loan, lines of credit, or commercial mortgages. But Citibank is nationwide, and anywhere we have a footprint, we can go.
Okay, excellent. That's what I thought. Just wanted to confirm it. So with Wendy, so, just dealing with, like everyone, on the panel, like they're stating, the times have changed, just dealing with COVID-19 and things of that nature. So what do you see, and, with your institution, what do you, prognostication, just dealing with, this year going into, 2022? Well, if you had to pull out your crystal ball, more or less,
Yeah,
your lending crystal ball, more or less, what would you say?
that's a challenge. That's a challenging
That's
question.
why I left it to the end, because
Yeah.
everybody has their own crystal ball.
Well, I think we all long for a return to normalcy, and normalcy would be, bridge loan lending, which we used to do on land at 50% loan to cost. LTCs on the construction loans back to 70, underwriting 120. But realistically, I don't see that happening until realistically, I don't see it happening until end of fourth quarter next year, this year, 2021, or into first quarter of 2022. That would be my guess. But what the bank is doing, though, is we're exploring, and again, this is to anyone out there who is hearing this, I want to be clear that this is very preliminary. Popular is looking to expand the footprint outside of the New York City market to areas like Westchester, Rockland County, just because of some migration, and we don't know if this migration is temporary. We've all heard of the stories of rent concessions and this mass exodus out of Manhattan, especially with young professionals. We don't know if that's permanent and if these people are moving back. So we're now exploring something that we would not have considered doing pre-pandemic. Westchester, Rockland County, even Connecticut, there's been talk of going to Connecticut for definitely on the perm market, maybe some construction. So that's in the, on the horizon.
Excellent. Thank you. Thanks a lot, Wendy. So you guys might not know, as far as individuals who are attending, but Anthony is having technical difficulties. So what we're going to do, basically, we're going to wrap everything up. And what will happen is all those who have attended, you're going to receive all the information from our panelists as far as their contact information. And like I mentioned, the main reason why I wanted to put this panel together is just, like I mentioned, I deal a lot with mortgage brokers and basically intermediaries and borrowers. And if I can't provide that financing, I always like to point those individuals to someone that might be a better fit. Because once, as a banking institution and all of the lenders kind of get on the same page, we can start moving New York City in the right direction as far as to put things where they were before. So I hope everyone enjoyed the presentation, and definitely reach out to our panelists. They are lending, they're actively lending, and when you call, they'll call back quickly. So I can't thank everybody enough for spending the time with us today, and reach out when you have an opportunity, and you'll have that information today from Anthony regarding all our panelists' contact information. Thanks again. Take care.
Thank you.
Thanks,
Thank
Charles.
you.
Thank you.
Thank you, everyone. Thank you, Charles. Bye,
Thank
everyone.
you.
Bye.